Do not sell your gold. Not into this. Whatever figure lands at the end of this week, the one the title brought you here for, the one every trading desk in Lower Manhattan is already circling like it is the most important thing that has ever happened, do not let it push you out of the one holding in your retirement that was actually built to outlast a scare. If you own gold right now and your finger has been hovering near the sell button because the headlines feel loud, this is the video I need you to watch before you do anything you cannot take back. Because here is the thing they are counting on you to forget. A single data print can move a price for an afternoon. It cannot change what gold is, and it cannot rewrite decades of history in a single afternoon. And the fact that reframes this entire panic is a quiet one. Gold has climbed its way up to become one of the most important reserves on the planet, held in the vaults of the very central banks whose paper you are being told to trust more than metal. The people who print the currency are the ones buying the alternative to it. Sit with that for a second, and then ask yourself whether a nervous headline at the end of the week really deserves the power you are about to hand it. So let me give you the honest answer to the question in the title right now, up front, the way I would want it if it were my money. Yes, there is a number coming that could knock gold around for a day or two. That part is real, and I am not going to pretend otherwise. A hot reading, a hawkish word from the Fed, a de-escalation somewhere in the world that pulls the fear premium back out. Any of those can send the price lower in the short run. But the number that decides whether gold actually did its job for you is not the one printing at the end of this week. It is a different number entirely. One almost nobody on the financial channels will point you to, and once you see it, you will stop flinching at the daily noise for good. In my years around the gold and silver world, sitting across from people trying to protect what took them a lifetime to build, I have learned that the measure that matters is not any single day's price at all. It is a ratio. Take the whole stock market, the big industrial average everyone quotes, and measure it not in dollars, but in ounces of gold. Ask how many ounces of gold it takes to buy that entire index. That one number, tracked across the decades, tells you more about where you truly stand than any print, any FEG meeting, any breathless alert you will ever see. Let me show you what that number has done, because this is the spine of everything. Go back to the great gold peak at the start of the 1980s. At that moment, after a decade in which gold ran from around $35, back when the window to the dollar was still open, to over $800, the stock market and gold had converged so tightly that it took only about a single ounce of gold to buy the entire Dow. 1 ounce. The metal and the market standing eye to eye. That is what the end of a long fear cycle looks like, when paper assets are exhausted and hard money is king. Now roll forward to the turn of the millennium, to the great stock mania, when everyone with a pulse was an internet stock genius, and gold was a punchline nobody wanted at the dinner table. At that peak, it took not 1 ounce, but many dozens of ounces of gold to buy that same index. The ratio had stretched to one of the widest gaps in modern financial history. Stocks were worshipped. Gold was forgotten. And that gap, that yawning distance between the two, was not a sign that gold was worthless. It was a sign that gold was on sale, and that the crowd had never been more wrong. Here is where it gets interesting, and where almost nobody connects the dots. That ratio does not sit still. It swings, slowly, powerfully, in long tides that take decades to turn, from the extreme where stocks are loved and gold is trash, all the way back to the extreme where gold and the market stand shoulder to shoulder. And every single time it has made that full journey home, the people who were quietly holding gold at the wide, lonely, forgotten end were rewarded in a way that a good year in the stock market simply cannot match. The daily print you are worried about does not even register on that chart. It is a ripple on an ocean. And if you want to understand why that tide swings at all, you have to understand what the whole system rests on. There was a moment when a sitting president simply closed the window that tied the dollar to gold, called it a temporary measure, and never reopened it. In one stroke, the anchor was cut, and the value of paper money was set free to drift on nothing but promises. That is the world you have been saving inside of ever since. And this was after nations had already learned they could not hold the metal down by force. A pool of major governments once pooled their reserves to defend a fixed price for gold, spending their own bullion to keep it pinned, and the metal broke them anyway, and they walked away. Remember that the next time someone tells you a single data print at the end of the week is what threatens your gold. Whole treasuries have tried to cap this metal and failed. A headline is not going to do what 8 governments with unlimited reserves could not. Picture someone I want you to keep in mind for the rest of this. A retired tool and die maker in Ohio. A man who spent 40 years making parts to 1,000th of an inch, who never chased a hot tip in his life and saved every dollar the patient way. He is the person the sell-off is designed to shake. He checks his account, sees red on the gold line. Here's a headline about a number coming at the end of the week, and his stomach knots because he did everything right, and now he feels like a fool for owning the thing that is supposed to be safe. If that is you right now, I understand it completely, and I am telling you, as plainly as I know how, that the man who sells his gold into that feeling is handing it to the smartest, calmest money on earth at exactly the wrong moment. Because who profits when you panic? Follow the money. The trading desks make their living on your churn. A frightened retiree dumping metal into a dip is a paying customer, and the fear that makes him dump is the product they are quietly selling on every channel. The big banks that carry concentrated short positions against these metals do not want a patient, informed holder. They want a nervous one who reads a single data print as the end of the world. And the financial media, which needs you glued to the screen for the next number and the next and the next, has no ratings interest in telling you that the only number that matters moves so slowly you could check it once a year and be fine. Let me be honest with you about the other side, because a man who only tells you the upside is a man you should not trust. Gold can fall. It has fallen hard before, and it will again. There was a stretch not long after that great peak where gold was nearly cut in half in the middle of its own bull market, and holders who did not understand what they owned bailed at the worst possible time. When a divided Fed starts talking tough, when a geopolitical fear that had lifted gold suddenly cools and the safe haven premium bleeds back out, the price can slide, and it can slide for a while. I cannot tell you the day it turns. I am not going to insult you by pretending I know the hour. What I can tell you is that none of that touches the long tide of the ratio, and none of it is a reason to sell what you built to hold. And that brings me to the strongest reason of all to hold, which is who is standing on the same side of this trade as you. This is the piece the daily number crowd will never emphasize, so let me say it clearly. Gold has now passed the euro to become the second largest reserve asset held by the central banks of the world, sitting behind only the dollar itself. Read that again. The institutions that manage the savings of entire nations have quietly moved gold up past one of the largest currencies on earth. They are not doing that for a single week's print. They are doing it because they can see the long tide too, and they are positioning for it. So let me stop right here and talk to you directly, because this is the exact point where protecting what you have becomes something you can actually act on. If you are a retiree with $100,000 or more sitting in a 401k or an IRA, and watching this makes you realize you have no real protection against the very cycle the central banks are hedging, I want you to get our free Retirement Wealth Protection Guide. It walks you through in plain language how everyday American retirees are moving a portion of their retirement account they already have into physical gold and silver, without taxes and without penalties, using a self-directed precious metals IRA. This is not just for insiders or the wealthy. If you have $100,000 or more in any retirement account, this is for you. If you are watching on your television, just scan the QR code on your screen. If you are on your phone or your computer, go to readfamilyguide.com. From our family to yours, no obligation and nothing to buy. Now let me pull you back into the story, because the ratio is not the only tide moving in gold's favor, and the second one is arguably even louder. Something changed in the way the world thinks about reserves, and it changed after a major power watched a large piece of its reserves frozen with the stroke of a pen. Every finance minister on earth saw that and drew the same conclusion. Bonds and balances held in someone else's system can be switched off. Metal sitting in your own vault cannot. It cannot be frozen. It cannot be sanctioned. It answers to no politics. And so the buying accelerated year after year, at a pace roughly double the decade before, a sustained accumulation the likes of which the modern market had not seen. Now watch what happens when you put those two tides together. On one side, the long swing of the ratio, decades in the making, that has always eventually carried gold back toward the market. On the other, the largest, most patient buyers on the planet, the central banks, steadily moving metal into their own vaults and up their own priority lists. And on the third side, you, being told by a screen to worry about a single figure at the end of the week. When you see it laid out that way, the panic starts to look less like wisdom and more like a trap. There is one more piece of honesty I owe you, because I promised you the caveats too. That central bank buying has cooled a little from its most frantic pace, and anyone who tells you it only ever goes up is selling you something. The reported numbers have softened. But here is the part that matters. Since that reserve freeze moment, a lot of this buying has moved quietly off the public ledgers because the buyers no longer want the world to see exactly how much they are accumulating. So the reported slowdown is not the same as the demand disappearing. In many ways, it tells you the accumulation got more serious, not less, the moment it went dark. And gold has been doing something else lately that ought to stop you cold, because it breaks a rule that held for a generation. For years, the textbook said gold should fall when the return on safe bonds rises, when the Fed gets tough and money gets expensive. That was the reliable relationship. Recently, gold has climbed anyway, holding its ground and pressing toward records even as a divided Fed talks about tightening rather than easing. When an asset stops obeying the rule that is supposed to hold it down, it is usually because a bigger force has taken the wheel. That bigger force is everything we have just walked through, and it does not care what prints at the end of the week. Now let me show you, honestly, why the ratio still has room to run, because the viewer who clicked deserves the arithmetic, not just a feeling. This is not a promise of any price, and I want to be clear about that. It is precedent. That ratio has already visited the neighborhood of a single ounce buying the whole market at the last great turn. It sits far, far above that today, out toward the loved stocks, forgotten gold end. For it to travel back toward the low it has actually visited before, one of two things has to give. Either the market that is measured in gold falls, or the gold that measures it rises to close the gap, or some of both. Run it either way and the destination is the same. When the ratio compresses back toward where it has genuinely been within living memory, gold measured against everything else does not tick up by a few percent. It multiplies. That is not a fantasy number I invented. It is simply what the same swing has done every time it has completed the journey. The engine is real, it is historical, and it does not need a single good week to work. Let me bring this all the way home to that tool and die maker in Ohio, because his situation is your situation. He is not trying to get rich by the weekend. He is trying to make sure that the money he set aside still buys a life when he is 80, that a shakeout engineered by people who profit from his fear cannot force him to sell at the bottom, and that what he leaves behind means something. The ratio, the reserves, the broken correlation, all of it points the same way for a man like him, not toward a promised price. I will never promise you a price. Toward the plain truth that the thing he owns is the thing the strongest hands in the world are also quietly gathering. Which is exactly why the timing of a decision like this is so easy to get wrong. Think about how these long turns actually reveal themselves. The central banks are already positioned. The insiders already know. But the pension funds, the mainstream advisors, the neighbor who laughed at you for owning gold, they do not arrive until the move is obvious to everyone, until it is leading every broadcast and every advisor is finally recommending it. And by the time the crowd is pounding on the door, the patient part, the cheap part, the part that rewarded the lonely holder at the wide end of the ratio, is already behind us. Nobody rings a chime to mark the turn. It only becomes clear in the rearview mirror, and by then, the easy stretch is spent. The whole point is to understand it and to be positioned before the crowd catches up, not after. So let me give you the practical, honest word on your own position, the part that is not a pitch. Size what you own so that no shakeout, no scary number, no bad stretch can ever force you to sell it. Own the real metal, not a paper promise that can evaporate in the squeeze. And never, ever sell into the bottom of a fear you were deliberately fed. Those are principles, not a prescription, and they are the difference between a holder who gets shaken out and one who is still standing when the tide turns. And when you are ready to protect and diversify a portion of what you have built, and just as importantly, what your children and your grandchildren will one day inherit, here is how to take the next step. Get the free Retirement Wealth Protection Guide. And if you have $100,000 or more in a retirement account, and you mention that you watched this all the way through, we will set up a free one-on-one educational web conference to walk through your specific situation. No pressure and nothing to buy. If you are on your television, scan the QR code on your screen. If you're on your phone or your computer, go to readfamilyguide.com. The honest reason to do it now is not some fake deadline. It is that the window where this decision is still calm and cheap and easy to make is exactly the window when nothing feels urgent, which is right now, before the crowd arrives and makes it hard. So here is where we end, right back where we started. There is a number coming at the end of the week, and the loud voices want you to treat it like the most important thing in your financial life. It is not. The number that matters is the long one, the ratio that has swung across the decades and always, eventually, carried gold home. Do not sell your gold into a headline. Sell your fear instead, and hold on to the one thing the central banks, the smart money, and 40 years of history are all quietly telling you to keep.